So where's this bounce back to start the new month following such sharp declines in August? Do you think that will materialize over the course of the next few trading days?
Well, thanks, Wilford, for having me on the show. A few things. In September, it's usually there's a good chance you're going to have a tough month. We look back over 28 years, all the way back to 1994, and we discovered it was something like 15 positive Septembers versus 13 positive Septembers. So it's a toss-up here. We've got to see how the economic data comes out. I think tomorrow is very important. The news today from Chengdu, the potential for a shutdown of that city, 20-some million people, all of that upsetting to the markets. And at a point now where after a terrific rally, which the bears regarded as a vicious rally, you've got a vicious take back here that the bears have been mounting over the course of the last few days on just the normal uncertainty that you get with a Fed fund hike cycle.
You mentioned there the sentiment coming out of Asia today. Also, we've got chip stocks lower because of that news that we mentioned just a few minutes ago. On top of that, yields with the 10-year about 3.2%. Is it very hard for U.S. equities to rise when we're still seeing yields try to settle higher?
I think you just said it there. I think what the market is looking for is to see where it's going to settle. I think one thing that's certainly understood after last week's message from the Fed chair in Wyoming, in Jackson Hole, essentially the Fed's serious about ending inflation. This is a good thing. It'll likely end a period of free money, which is not good. It builds pocket bubbles in cryptocurrencies, meme stocks, and things like that, and can even extend valuations in core asset classes. So all in all, we've got to say market, just as you said, looking for some stability. And right now it's a little bit early in the Fed funds hike cycle that is likely to last into next year. But the longer you go into one of these cycles, the more the market likely to get the message that the Fed will be successful at curbing inflation or stemming a rapid pace of growth, a 40-year high in that. And the market should calm down somewhat and consider the fundamentals of companies that are likely to navigate this pretty well as they move forward.
So, John, sum it up for us. Would you advise clients to be buying following that big dip we saw in August, or do you want to get closer to the June lows before you advise people to do so?
Well, the first thing is we're not big on backing up the truck. Our particular advice in my end of the business is for intermediate to longer term investors. So we usually suggest on layering in, dollar cost averaging, seeking babies that get thrown out with the bathwater at times when you get these pullbacks, because a lot of good stocks get thrown out with just everyday kind of not important stocks or stocks that don't deserve to go up. So look for the good ones at times like this. And you've got to remember, short-term investors tend to be leveraged. They're traders. They're impatient. That's where the real risk is in a thing like this. Intermediate to long-term, the U.S. economy and the markets have shown a tendency to, over the intermediate to longer-term period, to rise. Past performance, no guarantee of future results. But in the 39 years that I've been in this business, I can recall when I got in 1983, the S&P 500 was either somewhere between 121 and 161. I think we were at 3,900. We closed yesterday. That's a big difference.